Good day, ladies and gentlemen, and welcome to the Blucora Q4 2012 earnings call. At this time, all participants are on a listen-only mode. Later, we will conduct a question-and-answer session, and instructions will follow at that time. As a reminder, this conference call is being recorded. I would now like to introduce the hosts for today's conference, Bill Ruckelshaus, President and CEO, Eric Emans, CFO, and Stacy Ybarra, Senior Director of Investor Relations. Please go ahead.
Good afternoon, and welcome to Blucora's fourth quarter and full year 2012 earnings call. Before we begin, I'd like to remind you that during the course of this call, Blucora representatives will make forward-looking statements, including but not limited to statements regarding Blucora's expectations about its products and services, outlook for the future of our business and growth initiatives, and anticipated future financial performance. Other statements that refer to our beliefs, plans, expectations, or intentions, which may be made in response to questions, are also forward-looking statements for purposes of the safe harbor provided by the Private Securities Litigation Reform Act. Because these statements pertain to future events, they are subject to various risks and uncertainties, and actual results could differ materially from our current expectations and beliefs. Factors that could cause or contribute to such differences include, but are not limited to, the risks and other factors discussed in Blucora's most recent quarterly report on Form 10-Q on file with the Securities and Exchange Commission. Blucora assumes no obligation to update any forward-looking statement, which speak only as of the date the statement is made. In addition, during this call, our management will discuss GAAP and non-GAAP financial measures. In the press release, which has been posted on our website and filed with the SEC as an exhibit to the current report on Form 8-K, we present GAAP and non-GAAP results along with reconciliation tables and the reasons for our presentation of non-GAAP information. We have also provided supplemental financial information to our results in the Investor Relations section of our corporate website at www.blucora.com and as an exhibit to our current report on Form 8-K. Now I'll turn the call over to Bill Ruckelshaus. Following his comments, Eric Emans will review fourth quarter and full year results and our outlook. Then I'll open up to your questions.
Thank you, Stacy, and good afternoon. Blucora performed well last year, and we finished strong in the fourth quarter. Revenue for the full year 2012 was approximately $407 million, up sharply from $229 million in 2011, on strong growth in search and reflecting our acquisition of TaxAct last January. Adjusted EBITDA was $80 million compared to $37 million in 2011, again reflecting the acquisition of TaxAct and 35% segment income growth in search. In 2012, we started to deliver on the considerable promise at this company, combining disciplined operations with smart capital allocation and M&A. With the addition of TaxAct, Blucora is more diversified, faster growing, more profitable, and generates substantially greater free cash flow. As we look forward this year and beyond, we see multiple levers for creating value for shareholders, and will continue our dual focus on operational execution and sound investment. It's an exciting time to be at this company, and we really are just getting started. I will turn this to Eric shortly to discuss our results and outlook in more detail, but first I want to speak to some important trends and updates within our two businesses. Our search segment is coming off a fantastic year in 2012. Revenues expanded 51% in the full year to roughly $345 million. Segment income grew to over $62 million. Fourth quarter revenue was up 45% over 2011, so we enter 2013 with momentum. Our search performance reflects the growing strength of our distribution network, where we continue to bring high service levels, outstanding content, and superior monetization to a diversity of partners. We are a trusted partner with both Google and Yahoo and have been in business with both companies for over 10 years. This year, beginning in Q1, we are implementing changes with our downloadable applications partners in keeping with new agreed guidelines with Google. Because there is a fair degree of public discussion about these changes and their impacts, I'll provide some context here and discuss how I believe this will affect the industry and our business moving forward. In the past decade, users have evolved in how they consume digital content through applications on the desktop, mobile devices, and tablets. Search has played an important role in this trend, first and foremost in helping consumers find the content they desire. Search also allows developers of content to monetize through ad-supported models and to add functionality to their offerings. This exchange of value, where users consume content free in exchange for ads, sits at the center of most media business models, and it's no different for applications. On the Washington Post website, the exchange for free journalism comes in the form of display ads. With applications, it's toolbars and search boxes. Application developers are an important segment within our partner network. During the last few months, we've been working with these partners on implementation of new policies governing how together we integrate search within their software download processes. The end goals for users are worthy: greater transparency, more explicit permissions, and heightened awareness. We support these changes with Google and believe the industry will benefit from them in the long run. As with any change, there will be a transition period as the market takes time to digest. These changes will reduce the conversion rates of some of our partners over the next several quarters. We expect that these impacts will be felt in the back half of the first quarter and will bottom out sometime in the second quarter, and then we will begin to grow again. There will be a reset of sorts in the ecosystem. Application partners with compelling content and great utility will continue to thrive. The fundamental value exchange, content and utility for ads, will persist and strengthen. Lifetime values will increase over time as a result of improved user consent. As we look forward, we are cautious in our short-term outlook, but long-term optimistic about growth opportunities in our search business, and we are continuing to invest in search overall. Our team is developing tools and technologies to enhance our solutions for global partners, and our sales team continues to identify new partnership opportunities to grow our network. We are automating to drive quicker onboarding of partners, and we continue to focus on enhancing our meta-search platform to bring in multiple content sources and help us expand more quickly to mobile. Moving now to our tax preparation business. It's been an interesting start to the season this year. As you know, due to revisions to the 2012 budget passed by Congress early January, the IRS made late changes to tax forms and did not begin accepting or processing 2012 tax returns until January 30th, 8 days later than expected and 13 days later than last year. Additionally, the IRS won't begin to process returns that include certain credits until mid-February. Also, many employees received W-2s later than usual related to health insurance reporting requirements in the Affordable Care Act. As a result, the industry overall is off to a slow start this year across all tax preparation modalities. Instead of the typical early season peak, we are seeing that peak spread out over a longer period of time. The delay in IRS processing and changing taxpayer behavior challenge comparisons to prior seasons. However, the data that we've seen thus far suggests that we are performing well to date. We continue to believe the digital do-it-yourself category will demonstrate healthy growth again this year, and we expect Tax Act to grow filings in line with the market this season. We see a continued secular shift to DDIY within the tax preparation market. Tax Act is well positioned in the category as the leading value brand, and we continue to have confidence in our ability to participate in this secular growth and build upon our share position in the future. Last summer, we made focused investments in 4 key areas: instrumentation and business intelligence to improve filer retention and acquisition, core product enhancements to simplify the tax preparation experience, tablet and mobile product introductions, and additional offerings around basic tax prep to bring more value to our filers. We continue to believe Tax Act offers a comprehensive product at a considerably more fair price than alternative DIY solutions. We look forward to competing aggressively this season and beyond to build share, grow awareness, and expand the business top and bottom line. We are pleased with the early returns thus far. Our development efforts are validated by favorable reception from customers this year and positive product reviews, including an excellent rating by PC Magazine. I want to spend a few minutes discussing a few of the new offerings this season. This year, we launched our mobile app, DocVault, for organizing and saving tax documents. DocVault empowers consumers to create digital copies of tax documents and information for free. Images can be uploaded to TaxAct secure servers throughout the year, where they are encrypted and saved. With the addition of DocVault, our filers now have a suite of TaxAct products to use across a variety of devices for seamless year-round tax prep assistance. Also new this season, we are partnering with a leading mediation company to offer our filers expert representation in IRS and state income tax return audits. For a low upfront fee, tax audit defense CPAs, IRS enrolled agents, and tax attorneys guide members through an audit from start to finish. TaxAct filers already receive free step-by-step audit guidance, one-on-one help, and accuracy guarantees to help reduce the likelihood of an audit. Our new audit protection service enhances these offerings and aligns well with our complete and affordable portfolio of tax prep solutions. We are also trialing a new product, Legal Act, an easy and affordable DIY solution to create a last will and testament in a few simple steps. After completing an interview-based questionnaire, users can preview and edit their will and then print or download the document. More than 7 out of 10 Americans do not have a will, in part because of the assumed need to hire a lawyer to put one in place. With Legal Act, we empower our filers to do it themselves. Overall, I'm very pleased with the progress at TaxAct. We entered the current season with increased momentum driven by product enhancements and programs aimed at increasing consumer awareness, all of which position us for growth this season and beyond. Before I turn the call over to Eric to go over the performance and financials in more detail, I want to take a moment to update you on the capital strategy at Blucora. We changed our name to Blucora last year, shortly after acquiring TaxAct, an acquisition that transformed our business from one predominantly focused on search to a company with a broader mission, to provide industry-leading online solutions to consumers and business partners. We are pleased with the performance to date of our combined businesses, and we continue to generate strong free cash flow. In evaluating opportunities for shareholders to participate in our success, the Board of Directors recently authorized a $50 million share repurchase program. This relatively modest buyback program will help us offset equity dilution and return value to our shareholders while maintaining flexibility to pursue investment opportunities in the future. In summary, we're optimistic about the future, and we are executing successfully against our plans. We look forward to 2013 and having you on board. With that, I'll turn it over to Eric for more detail on our performance.
Thanks, Bill. Let's jump into the results for the fourth quarter and full year 2012. Fourth quarter consolidated revenue was $97.5 million, up 46% versus prior year, and adjusted EBITDA was $12.1 million, up 19%. Non-GAAP diluted EPS was 24 cents, up from 17 cents, and GAAP diluted EPS was 4 cents, down from 57 cents versus the prior year. The year-on-year decrease in GAAP EPS was driven by 3 factors. First, in the fourth quarter 2011, we recognized a tax benefit of $18.9 million, or 47 cents per diluted share, as we released valuation allowance on operating deferred tax assets. Second, the fourth quarter 2012 excludes the impact of a gain on derivative accounting of $1.9 million, or 5 cents per diluted share. And third, the fourth quarter 2012 includes the impacts of the TaxAct acquisition-related costs, most notably amortization expense on the acquired intangible assets. For the full year, consolidated revenue was $406.9 million, up 78% versus 2011, and adjusted EBITDA was $80.4 million, up 120%. Revenue and adjusted EBITDA benefited from the acquisition of TaxAct consummated on January 31st, 2012, which contributed revenue and segment income of $62.1 million and $30.1 million, respectively. Non-GAAP diluted EPS for the year was $1.70, up from 74 cents in the prior year, benefiting from the TaxAct acquisition. GAAP diluted EPS for the year was 54 cents, which is slightly down year over year, reflecting a combination of factors including the aforementioned tax benefit in 2011, which was partially offset by the impact of discontinued operations in the first half 2011, and the 2012 acquisition-related costs. Before moving on to segment performance, I want to touch on the 2012 pro forma results, which include full-year Tax Act results and exclude the impact of purchase accounting adjustments and certain non-operating expenses. Consolidated pro forma revenue and adjusted EBITDA were $430.4 million and $90.9 million respectively. Pro forma non-GAAP net income was $80.9 million, or $1.94 per diluted share. Additionally, pro forma levered free cash flow was $81.9 million. Lastly, we finished the quarter with cash and cash equivalents and short-term investments of $162.3 million and debt of $74.5 million, or net cash of $87.8 million. Now for our segment performance. Search had another strong quarter, generating $96.3 million in revenue and $17.4 million of segment income, up 45% and 36% from prior years. Search performance continues to be driven by our distribution business, especially from distribution partners launched in 2012. Revenue from these partners for the fourth quarter was $18.3 million, and for the year was $38.3 million. We are pleased with segment income margins, which were 18% for the quarter, down 120 basis points versus last year, due to our mix shift from owned and operated to distribution, which represents 89% of fourth quarter search segment revenue. For the year, search revenues were $344.8 million, up 51%, and segment income was $62.2 million, up 35%. Again, the results were driven by distribution revenues, which grew 67% in the year. In short, it was a great year for search. Turning to the tax preparation segment. Fourth quarter revenue for the Tax Act business was $1.2 million, and the business generated a segment loss of $2.5 million, both of which are in line with expectations for periods outside of the tax season. As previously mentioned, the revenue for the year was $62.1 million, and segment income was $30.1 million on an as-reported basis. On a pro forma basis, revenue for the full year was $85.6 million, and segment income was $40.5 million, which represents 9% and 8% year-on-year growth. Unallocated operating expenses for the fourth quarter were $2.8 million, and for the full year were $11.8 million, both up from the prior year, reflecting increased resources and infrastructure needed to support multiple businesses. Let's spend a few minutes talking through our expectations for each segment. The search segment has some short-term headwinds in light of the recent policy changes instituted by Google that will impact a portion of our distribution partners. As Bill said, we believe these changes are good for users and therefore good for our business long-term. But as we've seen in the past, events such as policy changes can have short-term negative impact on the business. If history is any indicator, we along with our partners will assess the impact of these changes, adapt, innovate, and then begin to grow again. To give context, in 2010 we implemented changes that impacted certain distribution partners in our network. Although these changes adversely affected our financial performance in the first half of 2010, we believed the changes would pay off long-term, and by the fourth quarter 2010, search distribution had begun to grow sequentially. In fact, since 2009, search revenue has a compound annual growth rate of 18%. The takeaway? This is a durable business that can have volatility from time to time. We expect the impacts of the recent policies changes to be most pronounced in the late first quarter and carry on into the second quarter, after which point we believe we will be in a position to grow sequentially. With that said, we expect first quarter year-on-year revenue growth in the low to mid-20s and segment income margin between 17 and 18%. As a policy, we do not provide guidance for the search business beyond a quarter or plan to do so in the future. But given the recent press and uncertainty surrounding search businesses such as ours, we feel it is important to provide some color on our 2013 expectations. For 2013, we believe revenue growth to be in the low double digits, keeping in mind year-on-year comps are challenging given our significant growth in 2012. We believe segment income will grow in the low single digits, as well as we will continue to invest in the search business through the impact of policy changes, and will continue to have attrition in certain of our most profitable owned and operated sites, most notably Dogpile and Make the Web Better. We believe there continues to be long-term growth opportunities in search, and while the Google policy changes will impact a portion of our search business short-term, we believe these changes will ultimately provide a stronger foundation for long-term growth opportunities, and we believe we are well positioned to capitalize. For our tax preparation segment, we are reconfirming our first half of the year guidance expectation of revenue of $86.5 to $88.5 million and segment income of $45 to $46 million. For the first quarter, we expect to report 73 to 74% of the expected revenue for the first half of the year, and segment margin will be between 47 and 48%. We expect unallocated operating expenses will trend up on a sequential basis to just north of $3 million. On a consolidated basis, for the first quarter 2013, we expect consolidated revenue between $156 and $161 million, adjusted EBITDA between $43 and $45 million, non-GAAP net income of $39.5 to $41.5 million, or 93 to 97 cents per diluted share, and net income of $20.5 to $22 million, or 48 to 52 cents per diluted share. Please note that our GAAP net income and EPS guidance does not include an expectation for non-cash gains or losses related to mark-to-market derivative instruments. Also note the impacts of such gains or losses are excluded from our non-GAAP financial measures. With that, I will turn the call over to the operator, and we will be happy to take your questions.